Thank you. Morning, everyone. Oh, gosh, it is bright up here, isn't it? Click through a couple. Here we go. As Attira said, I sit within the primary markets business at London Stock Exchange. So if you think about what an exchange does in terms of having investors on the one hand and issuers on the other, our team really is all about everything that's going on with issuers. So helping support companies already listed on market. And we have a very vibrant issuer services team that has developed hugely over the last 5 years. And of course, building a pipeline of those who may want to use our markets to list and raise capital as well. So that's my sort of day-to-day job. It's a great pleasure to be back here speaking. I've spoke at this conference once a number of years ago. It feels like a different era, given everything that's happened since, with the wars, pandemics, and everything else that's been thrown at us in the meantime. But I wanted to, and I promise you, no more than 7 or 8 slides, give you a little bit of an overview as to, some of the things that are happening within London Stock Exchange Group, which I think should be of interest to all of you here, not just because sort of we're bigger and better and doing things, but actually we're doing things that will ultimately deliver, I think, better services and enhanced products to you as issuers. And so understanding that a little bit better, because that's all changed. I noticed the EQ slide on what's changed since last year. We've gone through a change where our business has gone from a 5,000 person business to a 25,000 person business in the last 2 years with the acquisition of Refinitiv, the old Thomson Reuters data business. And we'll talk a bit about that and how that can potentially impact you positively in terms of what you can get from us. Lots of changes in markets, and I'm going to reflect on that. I think, if all you ever did was read the FT about what's going on in the London market, you'd be pretty depressed about life. I'm here to tell you that it's not as bad as all that, and just put it in a bit of context globally as to what's going on. That said, of course, we're not complacent about some of the challenges ahead of us. So I'm going to talk a little bit about some of the innovations we're making as an exchange to try and make our market as vibrant as we possibly can. Talk about the regulatory environment, because we are going through, as was hinted at earlier, I think once in 30 year complete sort of transformation of the overall listing environment, whether that's the listing rules themselves and the FCA consultations, through to a raft of other adjacent consultations going on at the moment, and so navigating that for you as issuers is clearly important. I think the final thing I wanted to do was sort of a little bit gaze into a crystal ball for next year. I was asked to, the sort of title was sort of 2024 and beyond. I think, I put these slides together last week, and as someone who, this morning spent the first half hour of my day talking to my colleague in Tel Aviv in a bunker, it feels like the world's already changed since the slides have been created. But I'll give my best efforts at talking about the things that we think are going to develop in the next year or so, whether it's sort of macroeconomic sort of impact of the various reforms that we anticipate and the timetables thereof, and how they will impact, again, you and other companies looking to follow in your footsteps. So the first thing I want to do was just again, talk a little bit about London Stock Exchange Group. For those of you who are based in London or have flown in and out of an airport in the last few weeks, you've probably seen the very garish blue adverts for LSEG, which have been everywhere, plastering London stations. For example, I think everyone, to some respect, knows the London Stock Exchange. We are the sort of heart of the business still. We've been around since 1698. We like to think of ourselves as a 300-plus-year-old fintech business in many respects. But clearly, with various acquisitions we've made in recent years, and particularly the Refinitiv business, we are now really quite a different business and a much more broad business that can benefit you as customers. So we have clients in 190 different countries. We now have people on the ground in nearly 70 locations all around the world. So this is it's a very much transformed business. And in addition to what you'd think about as the London Stock Exchange, we have the world's leading foreign exchange platform, FXall, which came with the Refinitiv business. We have a majority stake in the world's leading bond trading platform in the US, TradeWeb. We have the world's leading clearinghouse, London Clearinghouse, which may impact many of you around the table here in the sense that your securities ultimately many trade and clear through that mechanism. We have the world's largest index business through FTSE Russell by assets under benchmark. And of course, we've still got a capital market that we think is doing some good things too. But it's a broader business. I think in particular the data and analytics business that we purchased with Refinitiv. Many of you will have already seen, if you haven't, I'm sure your investor relations team will have done, the added services that we can now provide you, the data which we can provide you, whether that is third-party research that's being published in the market, whether it's ESG data that Refinitiv prepares, whether it's other data that exists within the group, Reuters News. These are all things that we now funnel through our issuer services platform, which we're able to do now, which we just weren't a couple of years ago. So for those of you interested in that, please talk to any of us. We've got James, Emma from our issuer services team here in the room. We're here to tell you more about that if that's of interest. On to activity. Is London dead and not doing anything? Well, look, it is quiet. And certainly when you put it in context of the last couple of years, there's no running away from that. We had 126 IPOs in 2021, raising the best part of $20 billion. Last year, we had 45, raising just over $1 billion or so pounds. This year, again, we've had 23 IPOs, raising about £1 billion again. So, IPO volumes are certainly low, but let's be clear, they're pretty low everywhere. And we're starting to see some green shoots of recovery in markets, which I think is fantastic. But let's not pretend that, a lot of the sort of slowdown in activity that I think we've all seen in markets over the last couple of years, it hasn't been a global phenomenon, given the challenges we faced in terms of the macroeconomy. And indeed, sort of geopolitical risks that we've seen pick up considerably with everything that's happened in Ukraine and now in Israel. But I think again, we've had we continue to be churning along quite well, not just on the IPO front, but in terms of further issues. So in terms of total capital raised, we're about double that of Amsterdam this year. I can't tell you the number of meetings I go into saying, "Is Amsterdam taking all of London's business?" Answer, no. It's still ticking along, well. We're still comfortably the largest exchange in Europe for activity. And on a global basis, we're sort of where we expect to be in a normal year, which is really the leading exchange outside of the US markets and Greater China in terms of activity levels. So, again, I mentioned the IPOs this year and last year, 23 this year, 45 last year. So 68 in the last 18 months or so. That is since Euronext Amsterdam had its last corporate IPO, which was back in September 21. So I think whilst the press narrative is slightly sort of doom and gloom and markets are all terrible and the London market's not working, I hope I can reassure you that actually markets are functioning pretty well. Yes, we expect, I'll come on to talk about that, markets to improve. The pipeline is building up. We're doing a lot on the regulatory side as well to try and make life easier and London more accessible. All of which will, I think, have some very positive implications. But even as things stand in the current environment we're in, and again, we're not complacent, but the statistics, show that actually the market is continuing to function, pretty well on a relative basis, even if absolute numbers are down for the reasons that are obvious. We're not slowing down in terms of the type of innovation and the type of partnerships we're doing to try and again, make London the most vibrant place to come and raise capital and meet with investors. We earlier this year announced a 10-year transaction with Microsoft, who took a 4% stake in our business, which I'm really excited about, not just because I think that takes us in a really interesting direction over time in terms of our digital asset strategy, and that's a whole topic for another day. But in the nearer term, I think there's some really exciting things we can do to embed the legacy Refinitiv data products through into the Microsoft suite of sort of office tools, all through the Azure Microsoft Cloud system, which I think, again, will be very interesting for you as consumers of that data. We're doing some interesting things in the private markets, and I'll talk a bit about that. Not necessarily because it affects a lot of you here that are listed already, but I think one of the things that, again, for you to be aware of is we're trying to make it easier for companies that are purely private to get from A to B to where you are, to the listed environment, where we've always felt that actually the gaps in terms of what needs to be done to go from purely private to purely to public are too big. What are we doing to try and make those transitions easier? Ultimately, to make sure that there is a very clear sort of runway for more people to join the club that you're already in. And hopefully that's a good thing for you. We're doing some interesting things in around retail inclusion. We passionately believe at the LSE that retail should be more active, not just in the secondary markets, but also in primary markets transactions. You'll often hear our chief executive, Julia Hoggett, say with some frustration, how can it be that for an individual investor, it is easier to buy crypto on their phone than actually buy into a company IPO with some great disclosure and great management, great prospects? Just can't be right. So we're doing work around that. And as some of you know, we took a stake in Primary Bid, which is doing some great things in terms of facilitating that access at the point of capital raisings. That's already being used in some IPOs, but also very broadly in secondary capital raisings. And I think we'll continue in that trajectory, particularly given the Austin review on secondary capital raisings that we saw last year, encouraging that. So we're quite busy in terms of innovating and trying to continue to make sure that we're doing everything in our control to make markets as vibrant as we can. I won't say too much about the sort of private market side, but again, just to reassure you that I think this ultimately will create a better, bigger ecosystem of listed clients over time. How do we make that runway easier for people? Well, firstly, we want to use our convening power as an exchange to help companies who want to raise capital in a private fashion to do that. I think if you strip back, what is a stock exchange? It's a place where people who need capital meet people that have it, with something in the middle that makes them trust each other. And it's really as simple as that. And so how can we take our convening power and make it easier for companies to use that in the private domain? We've launched, we took a stake in a business called Flow, which is doing some fascinating things in the private market. So helping companies raise Series A, Series B type size transactions, on a platform that LSEG effectively sort of controls and works with the Flow management team on. That's now had its first 5 transactions already. Launched this year, it had FCA approval to act as a marketplace for UK-based businesses, and that's something that we see as being very much an international product that will expand over time. And next year, we're really excited about launching what we're calling the intermittent trading venue. And this was something that came up in the Wholesale Markets Review a couple of years ago, which is if there are a number of companies around who perhaps aren't yet ready to IPO for whatever reason, they're not mature enough as a business, they don't feel ready yet to have to deal with the rigors of ongoing continuous disclosure, but ultimately are getting pressure day in, day out from early stage investors to provide liquidity. There's a solution that we're working on launching next year called the intermittent trading venue, where private companies can effectively run an auction every quarter, every 6 months. You can pick the cadence, again, to allow some people on the register to recycle shares. That's not going to be a primary capital raising venue, but a way of helping companies recycle registers ahead of an IPO, ultimately, which I think is a very good thing, and make sure that when people do get to the point they're ready for public markets, they've got a sort of cap structure that is ready for it as well. And they've started to get used to the ideas of disclosure around an event, but whilst not having to get all the way to the ongoing disclosure you have as a listed business that you all deal with day in, day out. So again, that's all I'm going to say about that. It won't be directly relevant to many of you here, but I think just understanding that that's what we're trying to do to effectively sort of broaden and deepen the funnel of companies that are going to work their way through to London markets. Now, this writing is really small, particularly if you're at the back, so I apologise. I hope the slides will be made available to you. But really, the key point of this is to say that we are really in the middle of a 1 in 30 year completely sort of rewriting of the rule book. And I have to say, I can't remember a time in my 25 odd years around the capital markets where you've had such huge alignment between the stock exchange, market practitioners, the regulator, the government, in terms of what needs to be done. So that this sort of obviously was kicked off with the Hill Review a couple of years ago. You'll all be familiar with in terms of London's effectiveness and vibrancy as a capital market, which made a lot of recommendations, which I think it's fair to say are being slowly ticked through. This really refers to some of the listing rule changes, some of the easier ones of which have been dealt with already around free floats, around dual class shares, around SPACs in the UK, albeit that that's a sort of minority sport these days, but it's there. And there's a lot going on which we expect to announce later this year for adoption early next year. The second Primary Markets Effectiveness Review, which talks to actually merging the premium and standard segments, and a number of things that, again, will make it not just easier for companies to access the main market, from the word go, but also for existing listed businesses to navigate ongoing requirements. And I'll touch on those more in a second. And there's a lot of other stuff that we're feeding into from a reg standpoint around some of those other reviews, again, to make sure that, for all of you, and for us as the sort of market operator, we give ourselves every chance to maintain London's vibrancy and leadership from a world sort of stock market perspective. It's not just on the reg side, but it's also some of the work we're doing outside of the rule book. It's fine thinking about the supply side, if you like, with all the rules, but actually how are we looking at the demand side? And I think there's a lot of good work that Julia's doing in her chairmanship of CMIT, the Capital Markets Industry Task Force, which is looking at a number of things, including pension fund reform, including provision of equity research following the recent Rachel Kent review, and how can that be looked at again in terms of I'd say the sort of unintended consequence of MiFID II in terms of particularly the ability of banks to provide research for SME businesses and some of the challenges that's provided. And I think over the course of the rest of this year, and with the Chancellor's autumn statement scheduled for late November, I think there'll be a whole raft of announcements that come through in that, which will be directionally, I think, very, very promising indeed. Again, the simplification of rules, I won't spend too much time on, but just to say that, I think there's been a bit of a step back to say, whilst the premium segment had some great things on the London market in terms of what set it apart from other exchanges, I think, we found that as more companies that were coming through, which are innovative, founder-led, want to do things in a slightly different way, we were frankly not terribly competitive. And some of the super equivalent rules that were imposed by the premium segments just were simply very tough for companies. So by collapsing the two segments, the premium and standard, into one single proposed main market segment, again, and there'll be some of the things that at the point of IPO, people found challenging that disappear, but also in respect of related party transactions, significant transactions, and the approvals required for those, and the thresholds that I'm sure all of you are sort of familiar with, that I think will be sort of quite far-reaching, and we expect those to be completed over the course of the next month or two, and put into place very early on next year, which I think will be good given how long we've been sort of talking about them. And then sort of, crystal ball territory. I think to start with, what do we anticipate in terms of market activity? I think does feel like we've been a bit unlucky at various points this year. I think when you think back to the pre-summer period, there were a number of clients we were talking to who were very keen on putting their foot down to do an IPO in sort of October, November, really round about now in this window. And just at the point where people are engaging lawyers, starting to write checks, really putting their foot down on execution timetables, you had Silicon Valley Bank and Credit Suisse, and everyone took a step back and said, do I really want to be spending money now on something that, could see me in the middle of another banking crisis? So I think you had a lot of people sitting on their hands. Volatility levels were still relatively elevated. We're now in a situation where the volatility indices are now pretty consistently back below 20. As an ECM banker in the past, that was always our sort of line in the sand. Anything above 20 looks a bit more difficult. Anything below 20, you should start seeing IPO markets and risk appetite come back. So I think we're sort of a little bit there from that standpoint. I think investors are still cautious. I'm sure you're all sort of seeing that, day in, day out, and they're ultimately dealing with net fund flows as well. That's been a challenge. I think, again, we've started to see that, moderate. And whilst we haven't seen necessarily huge net inflows, I think with things sort of stabilized, I think we're moving into a new phase as we go into next year. Certainly when we talk to the banks about, pipeline, I think people are saying this is the fastest rate at which we're receiving RFPs from companies at any time than we've seen for the last 12 months, which is really encouraging. I was talking to a partner at one of the big four audit firms last week who actually mentioned that they were stopping or slowing down taking on new IPO readiness mandates because actually they were struggling with the personnel to execute them. So I take a lot of those as very positive signals for 12 to 18 months from now, even if, right now I suspect we will continue to see some special situations over the course of the rest of this year, a continued flow of smaller IPOs, a lot of which are taking advantage of, VCT, and tax-driven, money, certain other, again, special situations. But I think in reality, we're probably not going to see a reopening of a larger cap IPO market until the spring of next year. A lot of that, of course, hinges on investor confidence, and that links into also where are we with the global economic recovery? And, in a sense, your guess is as good as mine. But it does feel at least as if we're at or around the top of the interest rate rising cycle. And whilst they may remain there, for a little bit, I don't think we're going to see necessarily that get worse from here, and that should feed back into people's investment decisions and a return to growth as we go into the next year or two, which again feeds into investor confidence and what they're prepared to invest in. I think the listing reforms will all help. As I say, as we go into next year, those should be in place. So I think you've been, for the last 6 months, in a slightly awkward, in a way, it's been quite a good thing that it's been quiet, because you've had the FCA kind of telling people what they want to do, but it isn't quite there yet. So when companies are now saying to us, well, actually, I'm looking at doing an IPO middle of next year, what rules do I need to start preparing towards? It's like, well, we'll know more in a month. So I think that will all start to land in a more sensible place. And again, people can start to build from there. On the pension fund reform, let's see what the Chancellor has to say in the autumn statement. But I think both in terms of consolidation of a lot of the very small DC schemes that exist, around, which by the nature of their size have been very, very risk averse. I think we believe will unlock further capital to invest in equities, and I think there are likely to be potentially what do I know, but speculation around certain potential sort of fiscal incentives at the point of the autumn statement that I think would encourage net further inflows from retail investors, which again sort of feeds into what we're trying to do, which is create not just the supply but also the demand that's going to match it as we go into next year. And that, I think, taken all together, kind of puts you in a place where that then becomes sort of a little bit self-fulfilling. Confidence is back, fund flows are going better, people have greater confidence about where the economy is going, and I think my sort of 20,000 foot view of what that means then for the capital markets is, and what we've seen based on other crises, is that as you sort of come out from that, it actually doesn't take long for things to start grinding forward in a positive way. And I think there's quite a lot of sort of pent up demand, both to do things and actually for investors to deploy capital. Once some of these things start to fall into place, I think and hope as we go into next year, some of those things will start to come together quite well. So that sort of brings an end to what I've planned to say as an introduction. I think there's a slightly longer slot. People are anticipating either throwing things at me or asking questions. So I'm very happy to take any questions or give any other further information on some things I've touched on.
Does it work? Does anybody have any questions? I'm happy to be the roaming mic.
Tom, I'm Paul Lynham. I'm the chief executive of the company. So we have obviously a foot in the UK markets. We're the dominant player and the second biggest player in the US. Why do you think companies are, on average, more highly valued in the US than they are in the UK?
Look, I think there's been a lot of talk about relative liquidity, relative valuations, and I think both of those, I think have slightly different dynamics to them. I think actually the relative liquidity one is quite easy actually, because there is a lot of OTC volume in the London market that doesn't get picked up in volume numbers, that is reported on a post-trade basis. But I think when you look at your Bloomberg screen, or hopefully your Workspace terminal, and you look at the volume numbers, you're actually seeing what's going on in the lit market. And so there's a not very good sort of apples to apples comparison. So when we've had issuers saying, should I look at the US market? It's more liquid there. And we've actually done let's take an individual stock, look at the entire volume, including everything that's going on in those OTC markets, including what's going through the banks, systematic internalizers, which isn't picked up in those volume numbers. Actually, you'll find that those data points are pretty comparable. So again, if people want further details on that, shout. On the valuation standpoint, look, I think there's an easy narrative which has been picked up in some of the press, which is, look, the Nasdaq trades on 30, London trades on 15, therefore the US is the place to go if you want to be valued higher, which I think is a pretty crude methodology to use, because London includes a lot of other types of companies, which are miners and banks, and so it's not really an apples for apples comparison. If you actually look at individual companies against their peers in the US, so you take Sage against Intuit, for example, and you look at how that has traded over the years. There's been many points in history where Sage has actually traded at a premium as something of a rarity in a tech market in London that is structurally short of supply. You take Wise and you look at how that trades against Remitly, which is its closest peer in the US. Wise trades at a massive premium. So I think you need to look at sort of company by company. Now, of course, there are some US companies that trade at higher valuations. That's probably driven a lot more because at the moment they're growing faster. They're in a US economy that's just growing faster than we are here in Europe. So I think you've got to adjust a little bit for that. And I think what you've got to do is be really careful of saying, if I take my UK business and I put it in the US, I'm going to get a different result. Because actually history tells you that's not going to be the case. We've had we had a lot of press interested in, of course, you have a week where Arm, CRH and Flutter all make announcements about going to the US market. Inevitably, that focuses the minds. Now, Arm, I would bet parts of my anatomy will be a FTSE 100 business in the next 12 months. It's still a UK PLC. I think their plan is to be a dual-listed business, but they just wanted to de-risk doing a dual-listed IPO at the same time. No one's done one since the Spitzer arena. And CRH is substantially a US business. Flutter is a business that has got a few bits to it, but where FanDuel in the US is driving an awful lot of their growth. So I think it was slightly unfortunate timing. But what it did what I think the story that people don't look at is in the last 10 years, there have been 20 UK companies that have gone to the US market to raise more than $100 million. 23, actually, it is. Of those 23, 5 have delisted, and of the other 18, the average share price performance is minus 45% against a broader US IPO market that is up 10, 15% over the same period. And only 3 are above their issue price. The US is a big, deep market, but it's quite domestic and parochial in its nature. And actually, international companies there have not necessarily fared the best. So I'd say have a careful think about it. And it may be right for some of the businesses that are becoming much more, US businesses. But I think for those people who are looking at it purely from the valuation arbitrage, I'd say watch it.
There's one other point which you didn't mention. So I agree with all of what you said, but I have been in the past the chief executive of a listed company with a premium listing in the UK, and I've always struck how the share price can move by dint of a tip in the newspaper with retail investors piling in. And certainly when I look at the US under the 401k regime, a lot of individuals are very heavily invested in the stock markets over there. Whereas here in the UK, you don't see anything like the same volatility, the same volume of retail investors. And certainly one of the things we're concerned about is with the Flint recommendations is we could end up disenfranchising retail investors even more. Is that something that you guys are concerned about?
I think, yes, because that's the last thing we want to do. In fact, as I mentioned, with some things we're doing with Primary Bid, we're trying to get retail greater access. I think, not only because it supports, liquidity, but frankly, it democratizes wealth creation opportunities and provides access that we know people want. So everything we want to do as an exchange would say pick up retail, and we'd like to see the 10% number it is in the UK overall actually go up a little bit. Look, I recognise it's also a bit of a tightrope that you're walking, because the more retail investors that you get in, the greater the risk of moving towards a sort of US type class action culture around if lots of retail participate and things don't go right, because they're not always going to go right. Equity is a risk asset. Do you go into a world of that? And one of the things we always say to clients trying to evaluate London versus New York is say, well, think about the cost. Look at your D&I costs, insurance costs of doing that. And that is driven purely by the fact that you can get sued just because the share price goes down, not in a European context around. We've had 2 class actions in the last 10 years here, both of which were around situations of fraud, not just because investors were hacked off. So I think, we're certainly trying to drive for greater retail access, but it's about, trying to drive it in a way that doesn't end up then having other consequences for market structure too.
Any other questions for Tom?
Hello. I was just wondering what the LSE's response is to the recent BASE consultation, given that we may enter into in inverted commas, UK SOX environment, which allegedly is going to be more onerous than that in the US. I've heard people saying we'll delist from the UK and we'll move to the US. So I was just wondering how the LSE take that and have responded.
Well, I won't talk you through our entire response, but I think you can be sure that it wasn't entirely in favour of going down that route. Look, I think there's a lot going on the governance side. I mean, you look at what the FRC are doing at the moment as well, which feels to us a little bit like tinkering around the edges, when I think there are certain areas where we think actually there needs to be a bit more of a sort of root and branch review, whether it's around remuneration, the role of proxy agencies, for example, where, again, there's some quite strong feeling within the LSE that I'm sure you've seen come through in some of Julia's, public comments. It's not straightforward at a time of a cost of living crisis that was referred to earlier to stick your head above the parapet, say we need to pay company execs more. But the reality is we're in a global talent market, and we fundamentally believe that companies here should be looked at in the same way as in any other market. I mean, to me, it makes no sense at all that a fund manager sat in London who invests his portfolio globally will look at corporate governance just because of a listing in one market through a totally different prism in terms of their approach on REM, for example, to something trading the London market. So I think there's a lot of things that are bubbling away behind the scenes that CMIT and others are trying to do their work around. So, and we continue to sort of feed into that given the direction of travel of everything else that we're trying to do to make life easier for listed companies and to try and make markets more accessible, it would feel to us to be not necessarily the direction we want to go in on that front. So I'll probably leave it at that, but you can piece together a little bit what our sort of feed into that consultation was.
Thanks, Tom. Any further questions for Tom? No. Thank you so much, Tom. That was really insightful and educational. So thank you for your time, and warm applause for Tom, please. And then...
Great pleasure. Thank you.